Hello everyone. I'm Allison. This video will tell you in detail about investing in the forex market. Be patient right away, because the video will be quite large and very detailed, but you can put it in the background and listen to it as a podcast. How to start forex trading. Initial deposit. In 2021, almost anyone can afford to trade forex, even if they don't have any start up capital. Brokers offer a huge number of special offers and bonuses that allow a trader to enter the market and start earning almost from scratch. How to start forex trading. First, you need to remember that forex is not traded in money, but in lots. One lot is equal to 100,000 units of the base currency. If we consider, for example, the standard United States dollar pair, one lot equals 100,000 euros. Most private traders don't have that kind of money, so you can trade with incomplete lots. The minimum transaction volume is 0.01 lot, or in our case 1,000 euros, but even this amount is very significant for a beginner trader. What to do in this case? Leverage will come to the rescue. Leverage. Brokers provide their clients with a margin lending service that allows them to trade without having large amounts on the account. Leverage is a financial instrument that gives a trader the ability to make transactions with amounts in excess of his own deposit. If you are a beginner and do not have 1,000 United States dollars at your disposal but want to enter the market, the broker lends you the missing funds, which, in the event of a winning deal, then gets back. What happens in the event of a loss? Of course, the broker does not want to lose his money, therefore, when making a deal, he automatically sets a loss threshold equal to the amount of your collateral. When the loss approaches this value, the trade will close and you will incur losses, and the broker will receive his funds back. This situation is called a margin call. Leverage is different, and their size depends on the specific financial instrument and its liquidity, as well as on the broker's dealing policy. Leverage is the ratio of the trader's own funds to the loan amount. For example, a ratio of 100 means that the broker provides a loan for an amount 100 times the trader's deposit. So how much should you start trading with? You don't even need to fund your account to start trading. You just need to register on the broker's website and create a demo account. Of course, in this case, we are not talking about earnings, but you can add up an idea of the market mechanism and the process of making deals. To be able to make real profits, you need to make a decent start up deposit. The size of this deposit directly affects the speed and size of earnings in forex. No matter how talented and knowledgeable a trader may have, he is unlikely to be able to make $1 million by investing $10. Minimum deposit. Theoretically, you can trade forex starting from $1. Some brokers offer such a minimum deposit, but as such there is no point in it. With such an amount, the leverage should be huge, and the larger it is, the easier it is to drain the deposit due to the slightest market fluctuations. The smaller the deposit amount, the higher the commission is charged to the trader. Scalping and pipsing strategies cannot be used with such a deposit, and it is impossible to learn how to manage capital for $1. To get full access to all market opportunities, it is enough to have $10. This is the minimum deposit on the Grand Capital Cent account. In this case, there is still no need to talk about big earnings, but you can learn the basics of trading and test your trading strategies. A cent account, like a demo account, is indispensable for a novice trader because it allows you to trade real money, but without serious losses. The minimum initial deposit is not always and not optimal for everyone. When calculating the optimal starting deposit, you need to take into account a number of factors: trading method, account type, preferred strategies, broker's leverage, desired amount of profit and allowable amount of losses. These factors are often interrelated. Optimal deposit. On most accounts, the minimum deposit is $100. With this amount, you can already count on a certain income. But at the same time, the loss of these funds will be offensive, but not critical. With a $100 deposit, you can safely trade micro lots, 0.01 lots, and check almost any trading strategies. It is better for a beginner trader not to put more than $100 into the account. Even if you are confident and have successfully traded on a demo account, the risks are very high. When you learn how to multiply your capital by $100, you can invest large amounts, $1,000 or more. The amount of $1,000 is sufficient for trading any instrument. It allows you to withstand drawdowns and hedge the risks of volatility in the foreign exchange market through transactions on commodity CFDs. A good profit is about 10–30% per month. You can calculate the size of the deposit yourself based on the desired profit. Conclusion: the optimal size of the initial deposit for a beginner is about $100. In order to really make good money on Forex, you need to invest from $1,000 and more. How to make your first trade in the Forex market. The Forex market is a unique financial platform. It gives traders the opportunity for both incredible earnings and equally incredible losses. Thousands of people every day decide to test their strength or just try their luck in the financial race, but most of them do not even suspect where their overestimated ambitions will lead them. Before embarking on this dangerous path, we advise you to carefully study the issue and weigh the pros and cons. If after that the desire to try yourself as a trader has not disappeared, we suggest that you familiarize yourself with the algorithm of actions for making the first transaction in the Forex market. Step 1. Choosing a broker. Choosing a brokerage firm is one of the key points in all Forex trading. Your chances of success directly depend on the conscientiousness of the broker. Remember that Forex is not traded by traders, but by brokers. It is brokers who offer you sets of financial instruments, set the size of spreads and commissions, swaps, quotes and liquidity. The choice must be approached very responsibly, so that later you do not blame the broker for your failures. Pay attention to the broker's rating and reviews on different platforms, but remember that not everything written on the internet can be trusted. The larger the brokerage firm, the more not only clients but also competitors, and they are on the alert. The final decision should be made based on how personally the trading conditions offered by the broker are suitable for you to meet your goals. Step 2. Installing the trading terminal. After you have decided on the choice of a broker, you can proceed to the next step: the choice and installation of a trading terminal. It is with its help that you will carry out trading on the market, so the choice should be treated equally responsibly. There are many different terminals that differ in cost and functionality. For a novice trader, the simplest free version is also suitable. The trading terminal can be downloaded directly from the broker's website. Installing it does not take much time and effort. Be sure to study all the functions of your trading terminal before trading. Step 3. Creating a demo account. As soon as you understand all the functions of the trading terminal and feel the taste of excitement, you can proceed to the next step: opening an account. But take your time to trade with real money. First, hone your skills on a demo account. A demo account is a demo account for training beginner traders. The essence of the account is that when concluding transactions, you use electronic money and do not risk real funds. The demo account is completely identical to the real account, with the same interfaces, functions and trading mechanics. Even experienced traders do not neglect the use of demo accounts. Be sure to try it out before opening a live account. Step 4. Opening a real account. And finally, after you study the terminal in detail, try to trade on a demo account, and get the first profit, you can proceed to opening a real account. Congratulations, you are already on the home stretch. Deposit money into your trading account and start trading. Choose trading instruments to your liking. You can start with popular currency pairs such as euro-dollar or dollar-yen. Let's look at a specific example of the EUR-USD currency pair. First, you need to look at the chart of price changes and try to predict in which direction the price movement will occur. Let's say we decide that after a certain time the curve will go up and reach the 1.1025 mark. To make a profit, we need to buy euros United States dollar now at a price of 0.0982, and then, when the price rises, sell. Open a new order in the Trade tab. In the pop-up window, indicate the details of the transaction. Remember that volume in Forex is always measured in lots. One lot is equal to 100,000 units of the base currency, that is, in our case, the euro. In the stop-loss column, we indicate the value at which the order will be automatically closed in the event of a fall in the price of the base currency. In the take-profit column, we indicate the value at which the order will be closed and fix our profit. Next, select the type of order, immediate execution or a pending order. And finally, we press the coveted buy button and wait for the price to reach the take-profit level, 1.1025, or the stop-loss level. 1.0950 in case of an unsuccessful transaction. After pressing the button, a notification about the concluded deal will appear in the lower window of the trading terminal. Please note that immediately after the transaction is completed, the profit indicator will be negative. This situation happens due to the spread that we pay to the broker for each completed trade. The size of the spread is set by each broker independently and may vary depending on the specific instrument in the general market situation. The spread is not measured in money, but in points. On average, the spread is 1.2 pips for the main currency pairs and 5.6 for the more rare ones. A pip is a one-step change in the last digit in the quote of a currency pair. If you see that the quote has changed in your direction, you can always close the deal ahead of schedule. Don't open two big deals at once. Even if you were lucky on a demo account, the market is volatile and it does not forgive mistakes. After clicking the buy button, you just have to wait and do not forget to follow the changes in quotes. After waiting for the required marks, feel free to close the deal and catch your profit. Forex trading psychology. We figured out the practical algorithm of actions. Now let's turn our attention to the main psychological aspects of making transactions in Forex. Traders should never neglect trading psychology. It is she who helps to understand and predict the behavior of competitors in the market and, accordingly, build your own effective trading strategy. Our perception of the market and the changes taking place in it is formed under the influence of previous experience and the characteristics of the psyche. Fear, greed, and self-confidence form patterns in traders' behavior. For effective trading, a trader must always control his emotions and adequately assess the situation and not be led by cognitive distortions, falling into panic or euphoria after the next transaction. The result of any single transaction can be considered random. The best strategy is to take each separate order separately, regardless of the previous and subsequent ones. Forex market patterns. There are several patterns in the Forex market that allow you to predict price movement in one direction or another. Forex patterns are often recurring events that cause a similar rate reaction. Almost all of them are based on the postulates of Charles Doe. The price moves along the trend until there is a clear, unambiguous signal to change the trend. History repeats itself. Each trend has three phases. Based on these postulates, several characteristic patterns of the Forex market were identified, which should be taken into account by every trader. The strength of a trend directly affects the likelihood of a trend reversal. At the same time, the strength of the trend depends on supply and demand and takes into account trading volumes. The flat state is replaced by a sharp price movement. This is often triggered by the release of significant news. The market cannot be in one state for a long time. The price moves constantly into the overbought or oversold zone. This helps to find the entry points to the trade. Session time factor. The trader should consider what session he is trading during. The most liquid are the American and European sessions. It is on them that price movements backed by liquidity take place. During the Asian session, the price of instruments changes to a lesser extent and often without significant support from trading volumes, that is, without long-term consolidation as a trend. The Asian session is also more focused on local currencies. Price always fills the gap. During weekends and holidays, price gaps sometimes occur when the closing and opening prices differ sharply. This often happens as a result of important news releases during this period. As a rule, price gaps form in the stock market due to the limited trading time of the stock market instruments and the low liquidity of some instruments. At the same time, in whatever direction the trend is directed, the price will fill the gap with the maximum probability. A sharp price movement is necessarily followed by rollback, correction. Moreover, the stronger and longer the movement was, the stronger the correction. This situation can often be observed when important news is released. The price moves within a certain range. The price usually moves within certain ranges and forms a price channel. Price movement is often limited to significant highs and lows. The more often the price approached them from one side or the other, the more likely it will push off from them. Excessively high volatility always causes the broker's spread to rise. Such a situation is often observed before major holidays or weekends, as well as with low liquidity for the instrument. Sometimes the spread increases during the night period. The market must take into account forecasts and expectations. Waiting for news also affects the course as well as the release of the news itself. Therefore, the price will move in the direction indicated by the forecast. A sharp change in movement is possible in the event of a discrepancy between the forecast and actual data. Seasonal fluctuations. Currency rates are subject to seasonal trends. Therefore, the movement of the rate can be predicted by the behavior of the instrument in the same month of the previous year. This pattern is often used when trading on non-farm payrolls. The patterns of the forex market serve as a signal not only for opening deals but also for closing them. For example, when trading on news, you should take into account the mandatory corrective market movement. Features of trading currency pairs. Starting his way as a trader, every beginner must first of all determine what and how he will trade. This choice should be made based on the desired goals, the available budget and personal preferences. To help you compare the features of trading with major groups of instruments and decide on the right ones, we are launching a new series of articles on choosing trading instruments. Let's start with one of the most popular options: trading currency pairs. What is a currency pair? A currency pair is the ratio of the prices of two currencies. The term is often used when it comes to trading in the forex market, where when buying one currency, a trader always sells another. The first currency in the pair is called the base currency, and the second is the quote currency. Where to trade currency pairs? On the previously mentioned international currency market forex. The uniqueness of this site lies in its decentralization. The formation of quotes here is influenced by the traders themselves. Forex is a kind of exchange office where currency pairs are purchased and put up for sale at each other's expense. How to trade forex currency pairs? The system is pretty simple. For example, what is the Euros United States dollar pair with a value of 1.2040? You have 100 euros and you want to understand how many US dollars you can buy with this money. You need to multiply 100 by 1.2040. It turns out 120.4. That is how much US dollars you can buy for 100 euros at this rate. What affects exchange rates? First of all, macroeconomic data affect exchange rates. A forex trader should always keep track of international economic news and current statistics, changes in the political arena, the results of central bank meetings, the latest data on unemployment, inflation, etc. Also, significant fluctuations in quotations can be caused by the degree of involvement of the country's central bank in the local economy to ensure control over the money supply and general market sentiment. Without fundamental analysis and constant monitoring of this data, your chances of successful trades go to zero. For the convenience of traders, there are special macroeconomic calendars, with the help of which it becomes much easier to navigate in a large flow of information. They contain the most significant events that can seriously affect the values of quotes. The second indispensable assistant for a forex trader is technical analysis. Technical analysis is based on the analysis of the price chart of the traded currency pair. The principles of work here are the same as when trading on the stock market. Wave analysis, indicators and chart patterns should be your best friends and decision makers. For the best result, we recommend using both fundamental analysis of important economic events and technical analysis of charts. Features of trading currency pairs. All transactions on rate differences are of the margin type. This means that each trade is carried out only on condition of the subsequent reverse operation. If you buy an asset, you must sell it in the future. Currency does not become your personal property, and you have no right to dispose of it. The trader has only the price difference between buying and selling an asset. Another important feature of trading currency pairs is the timing of transactions. It most often depends on the opening hours of large financial centers. The day in the forex market is divided into different sessions. Experienced traders know that it is worth opening and closing deals in the American and European sessions. It will be less profitable to do this in the Asian session and will bring almost no profit in the Pacific. Some traders are also looking at the best days to trade currencies. They are considered Tuesday and Wednesday. When choosing currency pairs as a trading instrument, it should also be borne in mind that they often have greater volatility than stocks. How to choose a currency pair? The most demanded currency on the market is the American dollar, United States dollars. It participates in most transactions, and it is in relation to it that other currencies are valued. The ratio of the currency of any country to the US dollar is a direct quote, and the relationship of the dollar to the currencies of other states is the opposite. Combinations in which the US dollar does not participate are called cross rates. The most popular pair to trade is Euros United States dollar. It accounts for about 70% of all transactions made. Many traders have been trading only it for years and have significant profits. Why is EUR/USD the most popular currency pair? Because both currencies in this combination are in demand all over the world, they are actively traded, the volumes of currencies are large, and the spreads are minimal. The current rate is available around the clock. Combinations of the yen, JPY, the British pound, British pounds, the Swiss franc, Swiss francs, the euro, euros, the Canadian, CAD, and the Australian dollar, Australian dollars, are also in great demand, about 85%. It is these pairs that are the main ones for forex, and they are the most profitable and safest to trade. Also, due to their great popularity, they have the highest liquidity and the lowest spread. In addition to the main pairs, there are also so-called exotic pairs, combinations of rare local currencies. They are particularly volatile and unpredictable. Operations with such assets can bring serious profits, but the risks are usually too high. Volatility is the range of price changes in a certain, most often daily, period. Some currency pairs are highly volatile, such as British pounds JPY and British pounds United States dollar. Trading them is very risky, and only professional traders who have a special trading strategy designed for strong price fluctuations should do it. The pairs Euros Australian dollar, Euros CAD are slightly less volatile. Next come Euros United States dollar Swiss franc, United States dollars JPY. It is these pairs that most traders trade, due to the absence of sharp movements in their quotes. The commonest currency pairs are Euros British pound, Euros Swiss franc. For them, fluctuations in quotations are 3.5 times lower than for the main pairs. How to trade the Euros Australian dollar pair? The Euros Australian dollar currency instrument is not the most common in forex. As a rule, traders from Australia choose this pair. The pair's exchange rate is influenced by the relationship between the EU and Australia, and many find it difficult to trade this asset. True, now everything can change, and the instrument for this instrument will increase due to the growing demand for risky assets, which Euros Australian dollar is. Briefly about Euros Australian dollar. There are many factors affecting the economies of these two countries, while the rate of this pair is less volatile compared to other exotic currency pairs. If you decide to test yourself and try something new, then you can opt for Euros Australian dollar as the best option. If you apply your knowledge and accumulated experience, then trading with this currency instrument can bring significant profits. Making an accurate forecast for Euros Australian dollar is a rather difficult task, since the currencies participating in it, as well as the reasons that affect their rate, differ significantly. The euro is strongly influenced by political and economic events taking place in the European Union, as well as by the dynamics of the United States dollars. The Australian currency is affected by oil prices, the value of gold and other commodity assets, as well as releases regarding the Australian economy. It is because of such a large number of fundamental factors that analyzing this pair can seem daunting. Although, on the other hand, if you study the history of price movements, you will see that the pair works well with technical figures and patterns. Forex trading. As you can see, the reasons influencing the dynamics of this asset differ significantly from each other. Currency pairs, in which the currencies of economically developed countries with an export-oriented economy immediately participate, are difficult to analyze since there are various reasons that affect their exchange rate. Here are just a number of factors that affect the dynamics of this asset: the cost of precious metals, agricultural products, black gold, data on the economies of the EU, Australia and the USA, policy of European and Australian regulators, inflation rate, unemployment rate and business activity in the European Union, USA and Australia, demand for euros and United States dollars. This pair is a highly volatile instrument in which two assets are involved, with completely different specifics. Newbies are intimidated by the complex forecast for this instrument. However, if you take into account all the factors that affect the rate of this pair, you can trade quite profitably. Why don't trading strategies work? Imagine that you have studied a set of rules and an algorithm of actions that should lead you to a profitable trade. You check every step you take with the popular authoring strategy with hundreds of enthusiastic reviews and irrevocably drain your deposit. Who is to blame? Yourself or the author of the strategy? Why do the same algorithms work for some and not help others? Let's figure it out. A trading strategy is instructions that give the trader a clear idea of when to enter a trade, when to exit, and when it is best to refrain from trading altogether. Forex trading strategies take into account when and on what time frame to trade, which currency pairs to use, and which lot to enter into transactions. Dozens of classic and authors' forex strategies are described on thematic sites and forums, which are presented as a magic wand for novice traders and for those who are looking for ways to make good money on the internet. From swing trading to scalping, certain specific strategies really make a profit. However, only in some specific situations that not all traders are able to take into account. A striking example is the rather popular martingale method. Its essence is that in case of a loss, the trader doubles the volume of the transaction. Of course, this strategy will work at some point. You can even put it into a simple algorithm and get an automaton at the output. However, the problem with martingale is that there are 7 bearish and bullish candlesticks in a row on the market. And 8 happens. A trader's capital is not infinite, and if the number of losses exceeds the allowable, a series of losses will lead to a complete loss of funds. Or take, for example, a basic 3 indicator trading strategy. 2 moving averages with different periods and an oscillator are used. It would seem, look at the MACD indicator, trade at the intersection of the moving average, confirmed by the oscillator signal. But if we put it on the chart, we will see false forex signals. Any strategy gives a large number of false signals. And only by working with it, adjusting it to yourself, feeling its reaction to price movements, a trader learns to cut off unnecessary things and pay attention to trading in those places where, it would seem, there is nothing. Sometimes a trader colleague from the outside can point to those entry points that you cannot see on your own. Although both are based on technical analysis, it's not that people who describe their win strategies are keeping an important part secret. The point is that a strategy is actually a set of measures. It is useless to follow a template and follow the instructions of trading books exactly if a person does not understand the market. A detailed guideline is not a panacea. When following any trading strategy, it is also necessary to combine market analysis methods. For example, the popular RSI, Relative Strength Index, indicator with a period of 3, should be used on time frames no older than an hour. Moving average indicators should have values less than 20, with the simple plotting method. For a longer period, you need to use the exponential plotting method, and the MACD, moving average convergence divergence, needs to be rebuilt. And the trader must also understand why it is good to combine this strategy on 3 elder screens. Each method of market analysis is also not universal, so a trader always needs to adjust to the current situation and not let everything go by itself. Studying all the factors affecting the market, the trader subsequently begins to act intuitively. Of course, you can write a detailed guide on any strategy with all these nuances, which will be equal in volume to the first volume of War and Peace. But in this case, the trader will face another problem: managing his money. And for money management there is also a set of rules that most market participants cannot follow. So, in order to make the right decisions and planning, a trader must know his percentage of profitable trades, which, unfortunately, is rare among market players. Incorrect volumes, misunderstanding of the basics of working with leverage, lack of a risk plan and a trading plan can also lead to errors. All these factors are closely related to psychology and self-control during trading.